This material is made available to you by or on behalf of the University of Melbourne under Section 113P of the Copyright Act 1968. It may be subject to copyright. For more information, visit the University Copyright website.
I don't mind, whatever is. Yeah, I'll probably.
Okay. Right. So, tonight's topic is portfolio selections and evaluations. We normally, in the past, sort of invite Andrew in at the end of the semester, after introducing different types of real estate assets. But for this year, probably for two reasons, we bring in this topic at a relatively starting point of the semester. So one is it might be useful to make everyone aware that we do face this choice between not just real estate, different types of real estate, but also different types of other investment opportunities. The second reason is obviously Andrew is a busy man, so we'll be away in late October. So. Andrew is one of our very successful former grads, so I'm sure he will say a bit more about it. And what's good of our program, which subject is most fun and which one's most boring?
This one's the most fun.
Yeah, okay, good.
I love this one.
He currently works at Telstra Super as a portfolio manager, right? So I'll leave the floor to you, and if you have something else.
Thanks, Hal. Okay, can everyone hear me okay? Good. If I get too quiet, just let me know and I'll shout a little bit more. So today I'm going to talk a little bit about sort of portfolio selection and some of the considerations that go into making a real estate portfolio. As a way of a bit of background, Hal mentioned I actually did the Masters in Property here at Melbourne Uni a number of years ago. I now work at Telstra Super, which is Australia's largest corporate super fund, and I'll get into what that means a little bit later. I'm a portfolio manager there, and I cover real estate and infrastructure assets. I started my career working in valuations at Ernst & Young, did a number of things there, worked mostly in valuations, a little bit in transactions. I moved to New York and worked on commercial transactions there for a few years, and subsequently have come back to Australia to do portfolio management. Sorry, I've got the contents there. The main things that I want to talk about today, in the context of sort of being a portfolio manager, the context of real estate investing in Australia, particularly for large institutions, the role of property within a fund. It has a very specific role and has unique characteristics compared to other asset classes. I want to touch on some of the different vehicles or ways of investing in institutional property, some of the portfolio considerations that come out of that. We'll talk about some of the sectors and strategies and how that influences decision making when looking to acquire something. And we'll do a bit of a focus on the retail sector in particular, because that's a sort of a hot button topic at the moment. I should say, if you have any questions as I go, please jump in. I'm really happy to answer them or try and answer them. This is material that I really like, so I'm really happy to answer any questions as we go. So, institutional investing in Australia. It's mostly done through superannuation funds. So they are by far the largest source of institutional capital for real estate investments in Australia. There are currently over 200 superannuation funds, and they have total funds under management of almost $3 trillion. So it's obviously a really significant part of the investing market in Australia. And this is expected to grow considerably over the next 20 years. In terms of the way super funds and pension funds and even insurance companies like them invest, they do a mix of things directly, where in-house specialists make the investments, and they do things through an investment manager where they outsource some of that responsibility. I've got up here, it's about, I think I said 38% invested directly and a bit over 50 through a manager. It's probably actually balancing a little closer to 50-50 these days. Of all of that money, about 6 or 7% is typically invested in unlisted property and another 3% in listed property. So overall it makes up sort of 9% of that allocation. And the other thing worth noting is these total funds in superannuation are increasing at a rate of about 8% a year. So it's obviously a really growing industry, and that means there's more and more money that needs to be deployed, and so more and more capital that needs to be invested into real estate assets. These charts just kind of highlight that. You can see on the left there with the blue line, with the total assets under management increasing at about 8%, it's anticipated that we'll get to total funds in the industry of almost $10 trillion by 2035. This chart here is the same thing, but just breaks it up by some of the various superannuation fund types. So you can see there that the main ones that are increasing are the industry funds, the large ones that you're probably familiar with, and self-managed super funds as well. Okay, so I mentioned before that property is typically a fairly material portion of these funds under management. So on average for for large super funds, roughly about 9 or 10% of the assets are allocated to property. If I give you, and that obviously moves around a little bit depending on the fund. If I give you an example, at Telstra Super, where I work, we have a total of about $21 billion under management, and about 12% of that is invested in real estate. So that's a little over $2.5 billion. And we have a further 5% in infrastructure assets, which have quite similar characteristics. Of that $2.5 billion in real estate, about 40% is invested in retail assets like shopping centres, about 30% in office buildings, and about 20% in industrial and logistics facilities. Okay. This chart here just highlights the change over time, with more and more focus on investing in some of these private market assets such as property, infrastructure and private equity. The overall allocation has increased from about 4% in the late 90s to almost 20% now. So it's an increasing area of emphasis for these superannuation and insurance funds. Okay, so that's kind of the broad context. These superannuation funds, they're obviously growing, they're investing a lot in property. The key question, I guess, is why do they invest in property? What are the specific attributes or characteristics that make property a good investment? The first and easiest thing is obviously just performance. Property has been a very strong performer for a number of years now. You can see property is the kind of dark blue bar there. So over 3 and 5 years, it's been the strongest performing asset class, certainly relative to REITs, so listed property, and to general Australian equities. And it's generally has been a strong performer. This chart, just to highlight some of that performance. If I took a sample investment of $100 back in 2013 and invested it across all of the different asset classes, you can see there that unlisted property would have grown to about $280, which is much higher than things like Australian equities, global equities. It's also worth noting that listed property with the grey bar there has grown well, but has experienced much greater volatility than unlisted property. And we'll talk about some of the reasons for that in the coming slides. So I guess this is sort of the crux of the conversation about why institutional funds invest in real estate. And there are really sort of 5 main reasons there. Essentially, it's a really reliable income stream. It's a bit of a hedge against inflation. It provides diversification benefits, alpha opportunity, and it can help match liabilities. So I'll get into exactly what all of them, those characteristics mean. First and foremost, property has really stable income, and income accounts for the vast majority of returns in commercial property, and it's got far less volatility than capital returns. So compared to shares or something similar, where you see movement daily, unlisted property, it's really stable. There's long leases. The cash flow has a high degree of certainty, and so it's really reliable. In institutional property, you also get a really diversified tenant base. If you think of something like a large shopping centre, you have hundreds and hundreds of leases. So it provides really predictable income. And investment grade properties often feature contracted rent for 5 or 10 years to really high quality counterparties and tenants. So again, it's a really sustainable and stable form of income. The second major benefit of investing in real estate specifically is it provides inflation hedging benefits. So when inflation is high, many of the leases in institutional property have triggers related to inflation, such as CPI plus kind of clauses, and you also have the ability to reset leases at the end of a lease term. So if there is an inflation breakout, you have the ability to sort of match the income to that profile. Property also gets to act as a diversifier to other asset classes within a portfolio. So it typically has low correlation to things like Australian equities, global equities, bonds. So it provides a bit of a ballast when the other asset classes aren't doing so well and are underperforming. Yet property provides some of those diversification aspects. It's not as impacted by market sentiment, so it's a bit slower to reprice and can reduce overall volatility in a portfolio, acting as a little bit of an anchor. In terms of alpha, do people understand the concept of alpha within a portfolio? No, essentially alpha is the extra return you get outside of just investing in the general market. So it's creating extra value by choosing the right manager, choosing a good strategy. It's known as active return. So it's by choosing assets that perform better than average. That's known as alpha, and that's an opportunity that you get in real estate. Finally, there's the concept of liability matching. So many insurance companies, for example, have payouts that they know they have to make. And so property, because it is so transparent and reliable, is a really good way for matching your asset growth to those liabilities that you'll have to pay out at a later date. So it provides a high level of certainty if you're managing a fund like that. And just to highlight that sort of stable and reliable income stream, I guess, this is direct property returns dating back to 1987. You can see there a couple of dips for the recession in the early 90s and the global financial crisis there, which did impact total returns. But if you have a look at sort of the yellow line, you can see that income has remained really stable throughout that period. So even in times of a lot of volatility, a lot of uncertainty, property income is really reliable. So it is a sort of a stabiliser in a portfolio. If you had the same chart for equities, it would obviously have a lot more periods of negative performance. Property within a portfolio will also have specific benchmarks that it is trying to meet in terms of return hurdles or performance. These are just examples that I've put up there, but property as an asset class may have just an absolute target. You may be expected to return 6%, 8% a year, whatever it is. It may have inflation-linked targets, so there might be a CPI plus target. So if inflation increases, your return expectations are higher. If inflation decreases, they're lower. And it may have peer comparison or sort of benchmark expectations. So you may be, your property may be expected to perform better or worse than the average. And I've used an example there of the MSCI Pooled Property Fund Index, which is essentially the average returns of all of the large property funds in Australia. So in terms of the approach to property, obviously there are a number of considerations when putting together a portfolio. I've listed some of the things that in my job I think about on a daily basis. So this is some of the key strategic considerations, I guess. The first one is about taking risk with property. Every investment has an element of risk in it, and so you only want to take risk when you expect to be rewarded. That should be reflected in the pricing, obviously, and that's kind of the crux of buying an asset. You're buying something that you think is going to provide a suitable return for the amount of risk you're taking on. Some of the ancillary costs and expenses associated with an investment matter too. So it's important to think of things like fees and taxes and transaction costs. You have to pay them. It's really the net performance that matters when thinking about adding a new asset to your portfolio. So it's really important to consider those transaction costs. Markets do misprice assets, so that's what creates the opportunity to find properties that are available at a price below that sort of intrinsic value. In order to do this, in order to make these timely decisions and effectively find these mispriced assets, funds need quality data, they need the right systems, and they need processes. And then the ability to implement and execute is obviously critical. Okay, so that's sort of why we would put property into a portfolio, and we've seen some of the relative attractiveness, I guess. The next consideration is how can you actually invest? There are a number of ways, a number of options, and I'm going to talk through some of them. I'm broadly going to talk about the main categories being direct, so investing directly, going through pooled funds or grouping together with other investors, or going into listed markets. I'll talk about how these different structures work, and we can talk about some of the pros and cons of each. So if you're putting together a portfolio of different asset types, different characteristics, some of the decisions you'll have to make: do you want to have equity or debt investments? Do you want the assets to be listed or unlisted? Do you want to own them directly or indirectly through a manager or some sort of different structure? Whereabouts do you want to invest? Is that going to be domestically? Is it going to be offshore? And which sectors and investment characteristics are you going to have with these assets? So we'll talk about all of these. I've got some charts that hopefully spell out the range of options. So these are kind of the broad categories. You can see you can invest in private markets across both equity and debt, and public markets across equity and debt. I'm not going to focus too much on debt investing here. It's a bit of a specialised thing. It's not necessarily a property investment, but it is a way of accessing property. Typically, for most funds, debt investments aren't included within the property team. They're generally allocated to a credit or unlisted debt team. These investment professionals have a different skill set, and are looking at a different risk profile, but they are ways of accessing property, and it's a way to invest across the capital structure and hopefully find different value points. Private debt does provide different diversification benefits. It's obviously highly stable and secure, although you don't get that upside in capital growth that you do from investing in equity. I'll leave it there. It's not something that most property investors think about, but obviously there are investors who are doing things like private placement debt or mezzanine debt as an alternative to investing in equity. If we just focus on the equity markets, obviously your first choice is whether you invest in private or public real estate. Do people understand the basic differences between public and private investing? I'll give a really quick sort of synopsis. So property funds can either be listed or unlisted. Listed funds are those which trade on a stock exchange, like the ASX, and they're typically called AREITs. AREITs or REITs, they change market value really quickly. Obviously, the trading is instantaneous, and it's a very open and transparent marketplace. The challenge is, because it is so liquid, it can be highly volatile, and you can see swings in the value of REIT portfolios occurring really quickly, up and down, based on market sentiment, just as much as sort of the fundamentals. So it's a great way for a really liquid investment that you can buy in and out of quickly, but it's challenging if what you want is a really stable investment type. Unlisted property funds are a little bit different. It's still buying units in a fund, but it's a different structure. So it's not publicly traded, so you can't just go to the stock exchange and buy shares. It's run by a manager, and they will set the terms. Essentially, they'll either have an open-ended fund where they can continuously raise new money and bring in new investors to purchase new assets and do that kind of thing, or it can be closed-ended, and meaning no more units can be issued, and it might have a fixed period. So it runs for 10 years, and then the manager is expected to sell the assets and end the fund life. Returns from unlisted property typically far less volatile. We've sort of talked about the stability, and they can also provide that inflation-linked income stream. The vast majority of institutional investors... Sorry?
What would be an example of an unlisted
So most of the big property managers will have unlisted funds. So AMP, GPT, Charter Hall, they all have typically a mix. So I'm trying to think of a good example. Dexus, I mean, they all have unlisted funds that they run, and so they're basically just open to institutional capital. So the advantage for the manager like that is they get a lot of control over decision making. They have sophisticated investors in there. If it is a closed-end period, they've got certainty of capital, so they know their sort of investment horizon. I can provide you a link with all of them. There's not that many, but they're all really big. So GPT, AMP, Lendlease, Dexus, ISPT all have these multi-billion-dollar funds, and that's where most super funds would invest. So that is kind of the next point, that this is where the vast majority of super funds invest. It does create a bit of alignment because there isn't this risk of investors pulling out really quickly and causing a capital shortfall. In terms of REITs, there's really no consistent approach across superannuation funds. Some funds do have REITs in, some don't. Sometimes they sit within the property team, sometimes they sit within the equities team. Often it's just a small portion of a property fund. So at Telstra Super, we have about 15% of our property invested in listed markets with AREITs. It does provide a little bit of a liquidity buffer, like I've mentioned there. If we need cash quickly for some reason, we can sell that down far more easily than we can sell a share in a shopping centre or a share in an office building. And then some funds do find REITs to be sort of an integral part of their strategy, but that's certainly much less common. Regardless of whether investors are investing in unlisted or listed markets, it is important to be aware of the characteristics and the market movements in both. Obviously, sorry, I've got a question here.
You've listed advantage of REITs as being liquidity.
Yeah.
What would be the disadvantage compared to having a share in an office building? Less returns? Or?
So the disadvantage of investing in REITs?
Yeah, so.
I'll cover the advantages of unlisted property in a second, but essentially the big ones are, with that liquidity comes much higher volatility because shares are sold daily. You see those sort of market movements, prices can correct really quickly, and what a fund like ours is looking for with property is a really stable profile. So that's one. From a manager's perspective, they don't have certainty for the capital to be able to do really long-term planning. So in terms of developments, refurbishments, that kind of thing, that can be challenging for listed managers who don't know how much capital they'll have because shares are bought and sold, whereas unlisted managers, if it is a 10-year fund, you know how much money you have and you can sort of plan accordingly. But I'll cover off some of the specific advantages of unlisted funds in a second. Just to quickly close this off, whether you're an investor in private or public markets, it's really important to understand what is happening in the other one because they're buying the same assets. So you need to get that sense of the demand-supply sort of considerations. We, in my portfolio, have examples where an unlisted fund owns a 50% stake of an asset and a listed fund owns the other 50%. So it is just different vehicles to access the same assets sometimes. But like I've said, we've covered some of the pros and cons. So the specific advantages of unlisted property. Performance has been strong. It's averaged about 10% over the last 10 years. It's typically more stable and less volatile than AREITs. There's less downside, accordingly, and you get to participate in that growth and often the decision-making process for the underlying assets. Okay, so that's kind of the listed versus unlisted comparison. If we just focus on unlisted or private market investments, I'm going to talk about a couple of the different ways you can do that. So the big ones are direct ownership. So that's obviously, as you would expect, that's sort of the pure ownership of real estate and the risk that comes with it. It's hopefully diversified from equities because you're obviously buying a property. It's very different to the share market, but it does come with additional complications. So it requires you to manage the capital budget. It requires you to have expertise to operate the asset. So sometimes that can be simple, but if you think about really specialised and complex assets like shopping centres, aged care facilities, hotels, there's obviously a high degree of expertise required in owning and managing assets like that. The other challenge with owning directly is for many premium assets, the equity size or the cost associated with owning those assets can be really large. So I'll show you a quick example. Last year, or the end of 2017, this shopping centre in Brisbane sold. It's known as Indooroopilly. AMP bought it. It's a really significant centre. They bought a 50% stake for about $800 million. That's obviously a fairly significant cheque for any one organisation to write. So that sort of thing is really challenging to do directly by yourself, and it's typically likely to be done through a fund that has multiple investors. That is I believe, the largest single asset transaction in Australia.
Is that different to 80 Collins?
So 80 Collins is, are you just thinking about the price?
Yeah.
80 Collins is a couple of different assets. It's got the hotel, it's got the office building. Maybe, I know that's sort of, they're quoting 1.3 billion, I think, but at the time this was the largest single asset. I think the way they break that up because of the hotel component, maybe it has broken this record. Certainly that's a pretty substantial one, and that's one that, again, no one investor would be able to afford that, so it's had to go to a fund like Dexus. If you want to know the most expensive asset in Australia, I believe it's Chadstone, which is valued at a touch over $6 billion, I think. So again, not one held by one investor. So that's direct ownership. On the right there, I've sort of talked about joint ventures. That's really similar, but obviously just pooling your money with another investor or a couple of investors. It has many of the same advantages, some of the same challenges in terms of needing to budget effectively, needing to have the right skills. The additional challenge with this is you need to have alignment between investors. Issues can be challenging if one party wants to sell and the other one doesn't, or if one wants to redevelop or something like that. And then we've got the wholesale funds that we have talked about. These pooled funds allow for many investors to join together to purchase assets in a fund run by a manager. The examples I've given in my notes here: Dexus, GPT, AMP, Lendlease and ISPT. So they're probably the big ones to answer the question from before. As an investor, what you're doing then is sort of signing up to an agreed strategy. So these managers might run an office building strategy or a shopping centre strategy. There will be set characteristics. It might be around gearing and debt. It might be about which geographies it can invest in. Hopefully one of the benefits is the manager is bringing the expertise to manage a portfolio like this. So they should have in-house leasing, development teams. The flip side, or the cost for an investor, is you're likely paying higher fees to access this, and you lose control over decision making. If you're handing your money over to a manager like GPT, they get to make the decisions about which assets to buy. So potentially they're buying something you don't like, or they're buying in a market that you don't like. Finally, it can be challenging to get your money back. So unlike REITs, where you do get that diversified exposure, but you can access your money at any one time, these unlisted funds typically have more challenging mechanisms for getting your money out. They often have set periods that you can do it, or lock out for a certain number of years. Okay, so in terms of the investors accessing direct property, historically not many of the large Australian investors have done it, although the list is growing. I've highlighted some of them up there, like Commonwealth Super, Cbus, Rest and UniSuper. You might know some of those names. Again, the benefits: greater control over the way you structure a portfolio. You're obviously making all of the investment decisions. You're not outsourcing that responsibility. You get transparency. Obviously, they're your assets, so you understand what is happening at the asset level. You don't have issues with alignment. If you want to sell, if you want to redevelop, you have that ability. Management fees are typically low. You're not paying someone else to do that for you. But it is not particularly liquid because you have to sell an entire asset if you need funds. It also does require more internal team resourcing. Again, as way of an example, Telstra Super in the real assets team, we have only 2 team members. That obviously doesn't give us great coverage to be doing things at the asset level, so we outsource a lot of that. Here I'm just sort of demonstrating some of the trade-offs between this direct and indirect model. Obviously, you're trying to factor in how much diversification you can get, how much control you want to retain, and how much expertise do you want to access. And so by owning directly, you obviously maintain a lot of control, but potentially don't get the diversification or benefits of accessing a team with transaction experience and knowledge of different markets. So again, the majority of Australian funds do use these unlisted vehicles to invest in. It's been driven, this sort of evolution, by a number of factors. Scale and diversification benefits. So like I mentioned, many of these funds are sort of 3 billion plus, so they own a lot of assets, and by investing in them, you do get those diversification benefits. The managers, by the nature of that scale, have skilled and high quality teams managing them, and there is a level of liquidity because you can sell units in these funds, although less than in the A-REIT market. Okay, so that's sort of some of the different vehicles you can invest in. I did want to touch on geography. So obviously the Australian market is small by sort of global standards, represents about 2% of the property universe globally. And so many Australian investors, while they have a lot of their funds invested locally, are increasingly looking at offshore investments. To warrant going overseas, offshore property has to deliver benefits that you can't necessarily get in Australia. That might be diversification, so you might be accessing a different asset class or a different type of property. It might be a different economic market, so you might think that the US or the UK market is growing more than the Australian market. I've touched on asset sectors there, so in Australia we don't have particularly developed residential or healthcare markets for institutional investors. And simply it can be because you think the return outlook is better. Obviously there are factors that you have to consider, like tax considerations for investing overseas, currency movements, fees that overseas managers charge, and the transparency you get being a small investor in Australia. Most Australian funds probably have a small portion of their portfolio allocated offshore. It's probably somewhere between 10 and 20%. Typically Australian funds are still targeting fairly core properties in OECD markets like the US, Europe and the UK. And this sort of investing typically requires scale, so you see the larger superannuation funds starting to do it more than the smaller ones that maybe don't have that capability or the resources to send people offshore. Having said that, I showed the charts before about how much funds in the Australian superannuation industry are growing, so it's pretty much inevitable that more and more funds will look to invest overseas. Prior to the GFC, in sort of 2007, 2008, many of the Australian investments overseas were in non-core markets and maybe slightly riskier assets, and so they had a fairly poor performance for a number of years following that crash. So in this cycle of investing, I think Australian investors are being far more conservative. Okay, so that's kind of the types of vehicles, whether to invest through listed or unlisted, direct or indirect. I want to touch now on some of the sort of relative sector and strategy considerations that you might have. So this is a bit of a summary of the Australian institutional property market in terms of the different sectors that are invested in. So you can see, there we go. You can see the vast majority of assets are in retail and office sectors. So what's that? About 85%. So that is the sort of the big part of the universe. About another 10% in industrial there. So between those three sectors, that is where the vast majority of funds invest. Performance historically has been fairly strong across all sectors, but there is obviously different levels of volatility and different levels of performance, and some of those sectors have struggled a bit more lately. This chart highlights returns over the past 12 months, I think up until March this year. That was the most recent data that was available. You can see, there we go, so property for the year, this is all direct and unlisted property in Australia, returned about 9.5%, down from about 11.5% the previous year. But if you look at the dispersion, you can see that office and industrial performed really strongly. Sorry, my pointer's not, there we go. Office returned about 12.9, industrial about 13.8, whereas retail only performed 5.1. That was a return 4% less than the previous year. And I think the really interesting part is yellow here represents the income return. So you can see that's remained fairly stable, but there was absolutely no growth in asset values. That's obviously, you've probably read a lot about it, and we'll touch on it a bit later, but it's a pretty challenged environment for retailers at the moment. So that's sort of the broad context of which sectors institutions are investing in. I wanted to touch on some of the strategic elements. So we've probably talked a little bit about this, but the purpose of property in most multi-asset sector funds is to be a bit of a stabiliser. So typically what that means is the vast majority of assets are invested in the core bucket there. Everyone has slightly different definitions about what fits in each bucket and what the parameters are, but essentially the concept is for taking on more risk on the horizontal axis there, you expect higher returns. From my perspective, core assets are typically things like stabilised office and retail properties, really diversified REIT strategies where you have a number of different funds, and they're assets where you expect to return sort of between 6 and 9%, but a very stable and reliable way. And then as you move up the risk spectrum, the returns get higher, but obviously you are taking on more risk and more uncertainty. So that might be sectors that are a little bit more volatile, like aged care and student accommodation, or more concentrated strategies where you don't have those diversification benefits, all the way up to sort of more opportunistic strategies that include much higher borrowing and far more development risk, which obviously has a greater level of uncertainty than for stabilised assets. As I mentioned, the vast majority of Australian funds sort of play in that core or maybe some of the core plus space. So if you are going to choose to invest with a manager or choose an investment strategy, I've just outlined, it's sort of a bit of a sample checklist, I guess, but the sorts of considerations that you'll have to go through. Things to consider include the experience and resourcing of the manager who is managing this investment strategy. Are they experts in that type of asset that they'll manage and acquire? Can they provide all of the necessary ancillary services like leasing, property management, financing? How is the manager aligned? Do they have money invested in the strategy as well? Do they have a performance fee for strong performance? And then some of the specific characteristics. So where are they investing? What sort of assets? What sort of occupancy? That kind of thing. So I've just highlighted a couple of examples. It's really just to sort of illustrate how different managers in the same sector can develop different sorts of portfolios. So these are 3 managers. They're all listed. They're all invested entirely in retail assets, but you can see some of the differences. The number of assets, obviously, Westfield are investing in really high quality malls, a lot of sort of super regional, so things like your Chadstone type assets. That's not a Westfield one. Vicinity, somewhere in the middle, they have more of a mix. They have more regional and sub-regional, some of the smaller assets, all the way to shopping centres of Australia that have the vast majority of really small neighbourhood centres. They're typically anchored by a supermarket with a few specialty shops. So while they are all investing in retail assets, they're doing it in very different ways. And you can see that in things like the number of tenants. Westfield has almost 12,000 tenants compared to Shopping Centres Australia, which has only 1,400. So the scale is very different. You can see the yield there. So Shopping Centres Australia expect to have more income, but potentially are taking on more risk given the profile of those assets. And I've just put up a few more metrics there. Again, you can see that Centre probably has the highest quality tenants in its portfolio, has the highest store sales per square metre, highest rents, but again, your income return maybe is less to compensate for that. Shopping Centres Australia, SCA at the other end of the spectrum for tenant quality, probably going to have a lot more sort of mum and dad type operators, but have lower occupancy costs, Vicinity sort of in between. So that's just meant to kind of highlight some of those differences that you might look at, strategies that are all in the same sector, but can be quite different in terms of the underlying characteristics. Okay, so that was obviously talking about sector-specific strategies. I just wanted to highlight some of the ways that even diversified funds or diversified strategies can be different. This is a bit of a sample sort of allocation of sort of mocked up a diversified fund here that invests across office and residential, retail, industrial and other assets. The red bars indicate the portfolio weightings for the sample fund compared to a benchmark. So in a fund like this, you can see that the manager has lower allocations to office and retail than average, but higher weightings to multifamily, residential and industrial. Basically it means if you were to invest in a fund like this, you would be taking a bit of a bet that multifamily and industrial sectors were going to outperform office and retail, or maybe it's just that you're not confident in office performance and office and retail performance. I've broken it down a little bit further, just to say, just to get a bit more granular, I guess. But in this example, the office portfolio may have a greater proportion of medical office facilities, which are typically a bit more defensive. And similarly, the retail might be more neighbourhood shopping centres, like we talked about before, anchored by major supermarket leases, and again, a more defensive sort of investment. So that was really just to highlight some of the ways that even strategies that can look quite similar can have different underlying characteristics. Okay, so one of the last things I was going to touch on is just to cover off on some of the different sectors. We have seen that the vast majority of Australian investors are invested in retail and office assets. But I wanted to sort of talk about some of the structural and economic elements, I guess, that drive performance. So this was something that was interesting to me. UBS did, sort of globally, they did investor surveys to see which sectors various investors thought were going to outperform. In 2017, the vast majority of investors thought that industrial was the most likely sector to perform strongly. That makes sense to me. It might reap some of the benefits of e-commerce, improved supply chains. Potentially it was a little bit undervalued compared to office and retail properties. So they did the same survey 12 months later, and industrial was actually less favoured, which I think surprised me a little bit, whereas retail was more favoured. I think the other interesting thing for me there was that some of the specialty asset classes like student accommodation and aged care had a big uptick in interest. So you can see how over time investors will change their focus based on that pricing and where they see value. So I think one of the reasons that we might have seen industrial decrease in popularity was because it had performed so strongly. So between 2017 and 2018, you can see how strong the performance was. That is the REIT index globally, and so you can see that industrial in the orange there has really outperformed. So possibly by 2018, investors thought that it had a good run and that there wasn't much value left in the sector, and that's why the allocation was a bit lower. Okay, so just to touch on some of the drivers and current trends in each of the major sectors. They do all have their own supply and demand profiles, and so when you're considering which sector to acquire assets in, it's important to understand some of these drivers. Office is obviously one where you need strong demand from the underlying occupiers or tenants. In Australia, we're currently seeing a real sort of bifurcation of the asset demand, with well-located sort of Class A and premium buildings performing really strongly, but B-grade assets really lagging behind in performance, and in many cases being converted or transformed often into residential apartments. Retail, I've talked up there that it has a solid performance history, but obviously faces an uncertain future given all of the online challenges, and we'll actually dig into that in a bit more detail in a second. Industrial and logistics have really strong near-term growth profiles. They have performed strongly, but it's now a relatively expensive asset class. There is a lot of infrastructure being built at the moment, and so that's providing a big boost to the sector, but it's extremely challenging to find these well-located assets, particularly ones that are suitable for last mile distribution and e-commerce. Multifamily, I've just put up there some notes. It's a sector we don't really have in Australia. Many developers are trying to push for it, but we don't sort of have that yet, that institutional grade residential product. There are strong fundamentals, so we're seeing more millennials and housing affordability decreasing, so many people are choosing to live or to rent for longer, and many people like that sort of urban environment close to the CBD, so that there is a possibility that becomes a more influential sector in Australia in the next couple of years.
What about build-to-rent products?
So build-to-rent's really what I'm talking about there with multifamily. It's there's a number of developers who are pushing quite strongly for it. It's not really yet a proven model in Australia, but Mirvac, Lendlease, a few others see a big future in it. I think the challenge in Australia will be can they convince people to rent in the same place for a number of years, because that's really where that efficiency happens, and you keep the same tenant for a long time and don't have to refurbish every time they leave. But yeah, I think it's likely to be a growing part of the Australian institutional market in the next couple of years. Okay, so I'm just going to touch on the retail sector. It's probably the one that has the most press about it at the moment. There's obviously a number of trends and themes that are impacting on it. So the big one that everyone's probably aware of, in late 2017, Amazon launched in Australia. Obviously some other operators like Kogan and individual retailers, bricks and mortar retailers, had an online e-retailing presence up until then, but the sort of emergence of Amazon is kind of the next phase of online retailing in Australia. Like I said, they're probably not doing anything revolutionary in terms of e-commerce, but they do have the ability to do things a little better than their operators. They can typically offer a quality of service that is superior, faster delivery time, greater range of products, lower prices, and that can be hard for domestic competitors to match. You can see in the chart there, which shows the percentage of retail sales that are online. Australia is still a long way behind some other countries, particularly China and the UK and even the US. So we are still lagging. Much of this typically relates to delivery issues. Australia obviously is a very large country with a fairly spread out population, but having said that, with so much of the country located in Melbourne, Sydney and Brisbane, it does feel like it's only a matter of time until that penetration rate starts to increase. So most of the research indicates that the retailers who are most likely to be impacted by e-commerce are those that sell sort of more homogenous goods like books or toys or electronics or sporting equipment. Aggregators like department stores, so Myer and David Jones, and then the discount department stores like Kmart and Target and Big W. Their value proposition is obviously providing a range of products to customers, but online stores can do that in a much more meaningful way, so they're also likely to be impacted. In terms of the sectors less likely to be impacted by online shopping, it's probably the things that you would expect, but things like groceries, prepared foods, hardware and auto are all things that are a little bit harder to replicate online. Hardware is sort of a good example. Most people like that sort of touch and feel of going into a hardware store and picking up the product, and that's a difficult experience to replicate online. Having said that, Bunnings has just announced that they are moving to an online store, so maybe that's a bit of a shift. Okay, in terms of the key trends for shopping centres, what we're seeing, a bit similar to the office market, is a real divergence between the performance of high quality and lesser or secondary assets. Shopping centres where a high proportion of the sales are in discretionary spending, things like fashion or luxury goods, have the potential to be disrupted because a lot of those goods can be sold online. Shopping centres are trying to remix as a result. They're trying to bring in more service-based tenants, so things like medical, dentists, other healthcare providers, entertainment options like cinemas. They're obviously things that can't easily be replicated online. And they're also being forced to spend a lot of what I call stay-in-business capital, so it's spending money not to expand the centre, but just to make sure it's up to a standard where they can compete in the local market. In terms of the sort of bright spots in the market, I guess the big one has been food and beverage, which is growing faster than overall retail spending. Things like fast casual dining has been a strong performer in recent years, but I think the challenge is how much can you fit into a shopping centre food court before it sort of reaches that saturation point. I think just to sort of put a bow around this, in the context of understanding some of these challenges that retail assets are facing in Australia, it's worth noting that we already have a fairly high level of retail space per person compared to other countries. You can see that the US up there on the left sort of leads the way, but Australia actually has the second most shopping centre space per person out of anywhere in the world. If you look at the chart on the right, you can see Kmart and Big W and Target and Myer all up there. It's worth noting that all of those retailers have above average space per person compared to the global average. So that's obviously a bit of a challenging environment. Myer and Target in particular are struggling, and landlords are beginning to think about how they can repurpose some of that department store space if these tenants have to give up their leases or don't renew. Just as a bit of a personal example, in our portfolio we have a shopping centre in Sydney. It's a 2-level centre and it has a Target that is struggling. They want to shrink the space that they occupy, and so we're trying to find ways of backfilling that space and finding other tenants who might be able to use it in a more efficient way. Just, I guess, to illustrate this point, this chart here shows the proportion of retail space occupied by department stores and shows how they've shrunk relative to other categories. Department stores used to be about 13% of all retailing space in Australia. That's down to about 6%. As I talked about before, food and beverage is kind of the bright spot there. You can see the growth up to almost 35%. But again, there's probably a saturation point where you can't fit any more food and beverage into a shopping centre and still make it profitable. Okay, so just to sort of wrap that up, clearly there are some challenges in the retail sector. There's low wage growth, increasing penetration from online retailers, and lots of pressure on household budgets with things like mortgages. We've seen a number of rate cuts. So the challenge for retail centres is how can they generate sustainable income growth. I think the answer has to be very much asset specific, but assets that have the right population catchment, the right demographics, match the centre, are the ones that will succeed. They need to be convenient and accessible, and design needs to be really efficient to get people in and out with the minimum of fuss. Landlords need to really focus on the tenant mix, getting the right anchors and mix of tenants, and this needs to be matched to the local population. And we talked a little bit about the CapEx, but spending really needs to focus on retaining existing customers and improving their shopping experience. And finally, I would just say that to maximise the value of the sites is going to be really important. So there might be potential for things like build-to-rent apartments to be developed on top of shopping centres, and we're seeing a little bit of that kind of thing. People have been out to Chadstone recently might have seen the hotel that's now operating out there as a way of really maximising the use of these sites. Okay, so that's kind of the end of my talk. Just to wrap up, I wanted to sort of highlight some of the things that I've touched on here today. I think the key takeaways are really that multi-asset investors like pension funds or superannuation funds that do invest in different asset sectors really need to understand what the purpose of the property portfolio is. What is the risk profile and what are the underlying drivers of the assets, and what are the overarching requirements? So is it about income? Is it about flexibility? Is it about liquidity? And then this needs to be, once you understand those requirements, that needs to be matched to the portfolio. So you need to get the right portfolio mix to take advantage of these underlying economic environments. That was everything I was going to cover. So really happy to answer any questions or how we can go into some of the few questions.
So any questions?
What would your advice be for people investing in listed retail investment funds? What would be your top 3 funds you recommend?
For listed retail? There's not that many left in Australia. I'm a bit biased because I have some joint ventures with some. I like the Vicinity portfolio. They're currently going through a process where they've divested some of their lower performing secondary assets and are really trying to upweight the quality of it. So I like Vicinity. I actually quite like SCA, which I had on the board before, who invest in the sort of smaller neighbourhood centres. It tends to be more essential services, day-to-day consumer goods. They don't have any fashion, they don't have any jewellery, any of that kind of tenancy. So I think in a low wage growth economy, I think that's a good place to be. I like some of them. I like Westfield a little bit, but I think they're overpriced at the moment. So probably Vicinity and SCA would be my 2.
Going back to that diagram you had, I think was it by UBS, you did the
Yeah.
about
This one?
that one. Why do you think retail has sort of grown, even though there's sort of like negative sentiment about it? Do you think it's more people think it might be like there's an opportunity there?
Yeah, the short answer is I have no idea. I think it's probably that they just think there's a bit of a mispricing. Many investors, particularly on the listed side in the US, think there was sort of an overcorrection, and so even though it is a challenging environment, the pricing is just so attractive that it's still worth buying. That surprised me though. I think now increasingly, if this was just to be an Australian survey, I think you would see very, very few investors who are thinking retail is a sector that's going to outperform. Anyone else?
Well, I probably have one, but multifamily.
Yeah.
So your prediction is
So, yeah, so it gets called different things. Some people call it build to rent, some call it multifamily. Certainly in America, it's a really established asset class. It actually makes up about 35% of all institutional investments over there. And that is partly historic reasons, it's partly the nature of cities over there. People move a lot more for jobs and for university, and so they're looking for that kind of institutionally run residential apartments. There's probably also a lot more cultural acceptance of living in apartments in America. I think we're seeing more and more of that in Australia. I think certainly for sort of Gen Y and millennials and even younger, there is increasing demand for being close to the city, and that, you know, we obviously have, there's only so much land that you can get close to the city, and so I think where does that trend of people wanting to live in really activated areas, I think people are willing to compromise a little bit more and live in apartments. So I do think we'll see far more multifamily build to rent type investments in the next couple of years. And certainly and certainly there are a number of Australian super funds looking at that kind of investment, and we have some in our portfolio in the US and in the UK, just not yet in Australia.
But just from an investment manager's perspective, so what's the barrier?
So
it's probably, I assume it's easier to pick American assets, residential assets.
So in terms of developers building it, it has just, well, the barriers have been mostly that it's been more profitable to build and sell the individual apartments. Obviously, the housing market has been so hot the last few years that that's been a more profitable approach. There haven't been managers that have had that skill set to really understand how to manage these assets and have a concierge and have that sort of really tenant-focused approach. But managers are getting better at that, and they're recruiting people from overseas who have run apartment buildings in the US and done that sort of thing. And then it's just been land prices, that it's hard to buy a site that is suitable for that kind of development. In terms of the scale you need, you probably need at least 100 units. So, you know, there's limited sites that have that, but the state governments in Victoria and New South Wales are trying hard to open up some of those sites and have sort of positive planning and zoning outcomes associated with building assets like that. So I think it's coming.
Can you talk a bit more about the liquidity provisions? Like, what does that entail
For some of the unlisted funds? Yeah, so it's sort of at the manager's discretion. Typically there are two sorts of unlisted funds. There are open-ended and closed-ended. So a closed-ended, the manager has a defined period of time that the investment will run for, and they don't guarantee any liquidity until the end of that term, and the investors have the ability to extend that typically if they want. So you might sign up for 10 years or 15 years, your money is locked in more or less for that period, and then at the end of that the manager sells all the assets and you get your money back. In open-ended funds, there is new investors coming in all the time, and so essentially to get out you're just trying to match, you know, a new investor's coming in, they're putting in $100 million, you're selling $100 million of units, and they essentially buy your units. So open-ended funds typically have more liquidity, but still not like REITs. The other option you have in terms of liquidity, at any time you can sell your units to existing investors. So whether that's an open or a closed-ended fund, but you're relying on the other investors in the fund being willing to purchase your units, and they may be, they may not be, and you may have to discount the units in order to sell them. So there are mechanisms. It's just it's a little bit trickier, and it's not at your discretion. If I use a current example, you might have seen in the press, Lendlease has a fund. It's about a $5 billion retail fund, and what they have, theirs is a bit of a hybrid, but every 7 years they have a liquidity window, and you can put in a liquidity request, and they try and match to other investors or sell at that point. Basically what happened to Lendlease, in a $5 billion fund, about $2.5 billion of units requested redemption at that point in time, and so they got stuck in this point where they now have to either sell half of their assets or try and find other investors, and it's not that easy finding $2.5 billion worth of retail investors at the moment. So they're kind of caught in this situation where even though investors thought there was liquidity, there might actually not be.
What happens at that point if there's not liquidity?
It's a very good question. I'm not invested in that fund, so I don't know the ins and outs of the documents.
But if you had that experience in any fund,
So liquidity is typically on sort of what's called a best endeavours basis. So the manager can obviously try and find ways to get liquidity, but it's not guaranteed. I think what would happen is, at some point, I think they've got 2 years to try and find this $2.5 billion. I think if they can't, they would essentially at some point have to go back to the investors and say, the options are we can have a fire sale and sell assets at a huge discount, or we can extend the liquidity period. It would probably end up being a little bit by negotiation. But yeah, the challenge is it's not guaranteed. So it is, although these mechanisms written into the contracts, it's always it can be challenging if the market is not forthcoming. Yeah, exactly, yeah. Yeah.
Can you take out security if your investment's big enough?
As in borrow against it?
As in like a bank guarantee or something like that?
What do you mean by that? What would you be guaranteeing? Like,
Guaranteeing the return, I guess, liquidity. Using underlying investments, maybe they've got other properties in the portfolio you might.
So I guess it would depend on the specific structure. So for most of these investments, they will have bank loans at the unit level. So you will invest in the fund, and they will take out loans. The manager will take out loans at the pooled asset level. Whether you can gear that yourself or I'm not sure. It's not something I've ever done.
All right, so you take one last question?
Yeah, sure.
If there is.
Yeah.
Can you explain the difference of the retail funds and the wholesale funds?
Yeah. So essentially all it is, retail funds have a much lower minimum investment amount. So it might be $1,000. Wholesale funds, it might be $10 million. And so essentially they're trying to attract different types of investors. And so wholesale funds, fewer investors, but potentially more sophisticated and more capitalised investors. Retail funds, lots of smaller investors pooling together. So a wholesale fund might have 20 investors or 50. A retail fund might have 10,000.
Okay, so I guess let's probably thank Andrew for this very insightful. And sort of also generate a tutorial exercise, right? So based on today's lecture. So the question set is on LMS, right? So I suppose maybe we have maybe 5 minutes break. So you can either go to the bathroom or take a look at the question, and then we'll come back and we'll also stay on with Alex to do some discussions.
Yeah, great.
Probably about 5 minutes later.
No, I didn't. Okay, that's all right. I'm good. I'll go do after. How are you?
You know what?
No, I think it was probably this time last year.
Probably.
It's like, you have your Jennings test?
Yeah. Retail market.
Yeah.
I'm trying to find some tenants for cider bells.
Okay. Oh, I imagine it's tough. Yeah. Whereabouts in society?
Where is it?
Okay.
So it's an identified NAC site.
Yeah.
So permits are ready to go. It's a smart contract. And they won't release it until it's back.
Yeah, that's hard.
I've got a PhD, we've got a bit of
Who do you need in this one?
the complexity is that it's 8,000 square metres, maybe 1,000 square metres. So the poles will have
Yeah.
They need about 2005 check, and then about 4,000. I think 4,000.
Yeah, okay.
Yeah.
I mean, our retail assets are struggling. Yeah, it's just a tough environment for retailers, all the department stores, discount department stores, all like that. We're not sure how much longer Maya will be surviving.
Well, Dayton Joe.
Yeah, no, go for it. I love it. Yeah, great. It's pretty much chasing my to be annoying. Yeah. I love it.
Be the same us. She's getting ready. That's why you were advocating last week for me to talk about lectures.
Wait for it. Wait for it. You just do that calculation. We'll invite back and we'll sit at the back and ask.
Just be a row of people just
Good one. I like it.
So, yeah.
How did you want to run it?
Briefly introduce the three questions.
Yeah, do we want, it probably depends whether you want like group discussion and work out answers to any of them, or if you want to just throw it open and, I don't